What's the number one financial threat retirees face today? Well, for many, it's not volatility and it's not inflation, it's debt. If you have debt and it follows you into retirement, it can quietly sabotage everything that you've worked to build up until the day you walked out the door from your previous place of employment. And the worst part is that most people don't even realize it until it's too late. In this video, we talk about the hidden risk of debt in retirement. We talk about what makes it dangerous, how to know if it's a problem, and importantly, how to fix it. Retirement is supposed to be a time of rest, freedom, and peace of mind. But for millions of Americans, it's become a time of juggling bills, watching your debt balances grow, and wondering if your money is going to outlast you or if you are going to outlast your money. The truth is, debt doesn't go away when your paycheck does, and even a small monthly payment can become a big burden if you aren't careful on how you handle debt. And it's not just about the numbers, it's about what those numbers can do to your mental health. Worrying about credit card bills, mortgages, or the leftover student loan can be very taxing on a person. And it's happening more often than you think. According to recent data, over 70% of people 50 years or older carry some form of debt, a sharp increase from previous generations, and that trend is still rising. It's time to talk honestly about debt and retirement, because you don't need to live with that stress for the rest of your life. There are clear strategies that can help you reduce or even eliminate your debt, and you can start today. Let's talk about the most dangerous type of debt first, high interest debt. And I'm talking about credit card debt, payday loans, and personal loans. High interest debt is the kind that grows faster than you can pay them down, even if you're paying a lot of big chunks with every single paycheck. In 2024, 68% of retirees with debt had credit card debt or some other high interest form of debt, but largely credit card debt. That means more than 2/3 of retirees that have debt are paying double-digit interest on that debt that was taken out months or even years ago. So it's amounting to a very, very big number. That kind of debt can drain your retirement savings. You may think that you're fine because you're making the minimum payment, but it does add up. And payday loans, even worse. Some of them come with APRs as high as 390%. 390%. They're designed to trap people in a cycle of borrowing that they just can't get out of. If you're in retirement and you're using payday loans to make ends meet, you're not alone, but also you're not stuck. We'll talk about what to do in just a minute. There's been a lot of noise in the market about Medicare brokers that are doing what's best for the broker, not best for the client, and they've gotten in a bit of trouble lately. Know that we limit our partners on this channel to 2 to 3 well-researched firms, and one of those firms is Chapter. Chapter is a Medicare advisor that has access to over 24,000 plans, saves their clients an average of $1,100 per year, and they're totally free to you. So if you have questions about Medicare or you just want a second opinion, give them a call at 440-703-1224 to see if they can help you. I will put the information in the description below and also remind you at the end. One of the most important tools you can use right now to understand your debt situation is what's called a debt-to-income ratio. It's simple to calculate but extremely powerful. If you're going into retirement or you're already retired, you should know your DTI ratio. You add up all of your monthly payments from all of your debt, mortgages, car payment, credit card payment, personal loans, all of it, and you divide the total of all of that by your monthly income before taxes. You then multiply that times 100 and you have your debt to income ratio. So for example, if you have $1,500 in debt payments and $5,000 in income before taxes, your DTI ratio is 1,500 divided by 5,000 or 30%. Financial advisors say that you should aim for less than 35%. In retirement, I'd focus on a number closer to less than 20%. And if your DTI ratio is 45% or higher, that's a big red flag, particularly if you're heading into retirement or you're in retirement. This means that nearly half or more of your income is already spoken for. That's before groceries, prescriptions, and a utility payment, as an example. But here's the good news. The DTI number is extremely important because it's your starting point. Once you know that number, you can do something with it. Let's talk about the elephant in the room, and that's your mortgage debt. Mortgage debt is the most common debt for people in retirement, by far. And while it's not considered bad debt, debt that you incurred for doing something that you may not even remember, it is still risky to carry a mortgage into retirement. Here's why. If your monthly mortgage payment is too high, it can limit your flexibility. If you go into retirement and you have more than 25% of your income going to pay for your mortgage, well, that too is a very risky situation for you, even though it's not considered bad debt. And many people going to retirement do have mortgages. It's just a fact of life. It comes from refinancing their home, helping family members, or other situations where you're carrying the mortgage longer than you normally would have simply because it was necessary. Unlike credit card payments, mortgage debt carries a much lower interest rate. But when it's eating up 25% or more of your income, it feels like a very big number, and that is a big number. It becomes a roadblock to essentials that you need to purchase during retirement. If this sounds like you, don't panic. There are strategies that you can implement that will help you help yourself. And we'll talk about those strategies in the What You Can Do section, which is coming up shortly. Now let's talk about two types of debt that you owe to the government: taxes and student loan debt. The problem with both of these is that if you don't pay them, the government can garnish your income or other if you don't have income. Let's start with taxes. If you owe back taxes to the IRS, the government can garnish your Social Security benefits. They can also put a lien on your property and restrict your passport. The enforcement isn't theoretical, it's real, it happens. And while the IRS rarely touches retirement accounts, typical retirement accounts like a 401k or an IRA, legally they have the right to do so. So letting an old tax bill just sit there unpaid in retirement isn't just dangerous, it could potentially be disastrous. And student loans are another unexpected issue. They can be enforced as well. And frankly, that is now happening. Many adults go into retirement with student loan debt because they financed their student loan over 30 or 40 years sometimes, or they have parental student loans for their children. In either case, if your pen went on the line and signed for it, there is enforcement that can be executed against you. Out of all the risks a retiree faces in retirement, market risk, longevity, inflation, unmanaged debt is one of the most dangerous because it doesn't just reduce your wealth, it compounds your financial vulnerability over time. If you enter retirement with too much debt, you may be forced to withdraw more from your savings than you were planning on. This in turn accelerates the depletion of your retirement funds and potentially causes you to outlive your money. At this point, you might be thinking, I'm already retired. Is it too late to fix this? Absolutely not. Debt may be heavy, but it's not permanent, and you may have more options than you realize. And that's what we're going to talk about now. You can refinance high-interest loans, consolidate payments, even explore a reverse mortgage, although I wouldn't suggest that as your first choice. You can work with a credit counselor to create a debt management plan, and even take out a home equity loan and use the lower interest debt to repay the higher interest debt and then pay down the lower interest debt. Even part-time income or a side job can take a lot of stress off of you, not just financially, but emotionally as well. Because every dollar that goes towards your debt today is one less dollar that drains your retirement tomorrow. So what can you do about it? Well, the first thing is you're going to make a list, and at the very top, you're going to calculate your debt to income ratio. If that number is over 35%, it is time to act. Target your most harmful debts first, especially credit cards and payday loans. Targeting your highest interest rate debt first is what's called the debt avalanche method. Alternatively, you can use what's called the snowball method, which means that you target the account with the smallest balance, pay that off, and you have a psychological win, and then you move on to the next largest, and then the next largest, until you're working on your last loan. Now, the problem with this method is it doesn't necessarily target the highest interest rate debt first. It just targets your smallest balance first. If you're still unsure where to begin, work with a professional. There are people that are professionals that help people like you do exactly what you're trying to do. A fee-only financial planner or a credit counselor can help you map out the way forward. And remember, this isn't about shame, it's about strategy. Millions of people face this challenge every single day. But with the right plan and a little persistence, you can enter or stay in retirement without the heavy burden of debt on your shoulders. Managing debt in retirement isn't just about money, it's about freedom. Freedom to have choice, freedom from stress, freedom to live the rest of your retirement without having to worry about if you can pay your bills that month. If you're carrying debt, today is the best day to start working on it, because every small change you make now will help protect your future. And trust me when I tell you, your future self will thank you for it. As a reminder, if you have questions about Medicare or you just want a second opinion, give our partner at Chapter a call at 440-703-1224 to see if they can help you. I will put that information in the description below so that you have it. Also, if you like this video, check out that video. Is a fully paid off home in retirement really worth it? This is Jeff Schmidt, and I will see you in that video right there.
Holy Schmidt!